Hey everyone, welcome back once again to our CA Foundation Business Economics series where we are discussing economic concepts in the most quick and practical manner. So, without wasting much time, let's get back to the video. So, today we will start a new chapter, chapter 8 Money Market, in which in this video we will cover Unit 1 the concept of money, demand, and important theories. So, here is an introduction. Money plays a fundamental role in every economy. It acts as a medium of exchange, a store of value, and a unit of account. So imagine a world without money, where you would have to barter goods for other goods. So means you have to exchange goods for other goods. This should make transaction cumbersome and inefficient. So money solves these problems by providing a universal accepted means of exchange. So here is fiat money used today does not have any intrinsic value, but it is accepted as legal tender because the government backs it. The value of money is maintained through trust in the system and the economy. So how money is measured? So money in an economy is measured in two key ways. First, narrow money, that is called M1, which includes physical currency in circulation and demand deposits, whereas the second, broad money, which is called as M2 and M3, it encompasses of M1 plus saving deposit, term deposit, and other liquid assets. So example, if India has rupees 10 trillion in physical currency and rupees 40 trillion in saving deposits, its broad money would be sum of both of these, that is M2, that is in our case $50 trillion, 50 trillion Indian rupees. Then comes the demand for money. So the demand for money refers to the desire to hold wealth in liquid form rather than assets like bond or stocks. So money is demanded primarily for transactions, precautionary and speculative purpose. So here are key factors affecting money demand. That is income level. That means which is higher income leads to higher demand for money. Second, interest rates. So higher interest rates, it decreases the demand for money as people prefer interest earning assets. And third, price levels. So higher price increases the need for more money for transaction. Example, theories of demand for money. So first is classical approach, that is the quantity theory of money, that is also known as QTM. So this, or the classical theory of money proposed by Irving Fisher, suggests that the quantity of money in circulation determines the price level. The equation is expressed as above. MV equals to PT, where M denotes money of supply, V denotes velocity of supply, P denotes price level, and T denotes transaction. So this theory implies that increasing the money supply leads to inflation. Example, if the money supply is rupees 1000 crores, velocity is 4, and the total transactions are 4000 crores, then the price level will be M into V divided by T, that is 1000 into 4 divided by 4000, that is 1. Then comes the second, the Cambridge approach. So this approach emphasizes that individuals hold money for two main reasons. First, to conduct transactions, and the second, as a precautionary measure, store of wealth. So the Cambridge equation is MD equals to K into P multiplied by Y, where MD is demand for money, K denotes proportion of income held as cash, that is cash money, and PY denotes nominal income. And third comes Keynesian theory of demand for money. So John Maynard Keynes developed the liquidity preference theory, which suggests that people hold money for three motives, as earlier also narrated. First, transaction motive, that is for day-to-day transactions. Second, precautionary motive, that is for unexpected emergency, like could be a medical situation. or some other purpose. And third, speculative motive, to take advantage of future investment opportunities. So example are, if a businessman expects a fall in bond price due to rising interest rates, they will prefer to hold money rather than invest in bonds. Then comes liquidity trap. So in a liquidity trap, the interest rates is so low that people prefer to hold money rather than buying bonds. This makes monetary policy ineffective, as increasing the money supply doesn't reduce interest rate further. So example could be Japan's economy in the early 2000s faced a liquidity trap, that is where interest rates were nearby to zero, but increasing money supply didn't boost investment or consumption. Then comes next, post Keynesian's development. So inventory approach to transaction balance, Baumol and Tobin suggest that individuals view money like an inventory of transactions. They hold a mix of money and interest bearing assets to minimize the opportunity cost of holding cash. So the square root rule estimates the optimal cash balance. So what would be the optimal cash balance as per this theory is C equals to under root of 2 into B by Y, B multiplied by Y divided by R. So where B denotes transaction cost of converting asset to cash, Y denotes total income, R denotes rate of interest or interest rate. Then comes Friedman's restatement of quantitative theory. Milton Friedman expanded the quantitative theory, arguing that the demand for money depends on permanent income rather than current income. So money is here treated like a durable goods, and demand is influenced by wealth, inflation expectation, and relative return of assets. So example, imagine a company that holds rupees 1 crores in cash to conduct transactions but wants to invest some of it in bonds to earn interest. If the interest rate on bond is 5% and the transaction cost of converting money to bond is rupees 10,000, the firm must balance between holding cash and investment in bonds using the inventory theoretic approach. So it will consider the both things and create a mix of them. Then comes MG extras. So here are two MG extras in this video. First, research a company's annual report and look at how much cash they hold. Discuss what might be holding cash, why they might be holding cash rather than investing in interest bearing securities. So what might be the reason? Could be they will be investing in their own some expansion assets, or could be another reason. And the second MG extras is observe how Indian households save money. What percentage of their wealth is kept in cash and why? How do interest rates on fixed deposits or FDs influence their decision? So these two are interesting activities, and I hope you will definitely try this out. Then comes to the end of the chapter, conclusion. So the demand for money is a crucial element in economic theories, influencing interest rates, inflation, and investment decisions. Different theories from classical to Keynesians offer insights into why individuals and businesses prefer to hold cash. The study of money demand helps central banks like RBI to implement monetary policy effectively, stabilizing the economy and promoting the growth. So that's it from this video. Thank you for watching. Keep learning, keep growing, and keep rocking. Bye bye.